Only 2 stocks in the world pass. My 5 metric test. Most investors are not investing. They are reacting. They see a headline, they see a chart, they see a product they like, then they look for reasons to justify a decision they already made. That is not a process. So I built one. No stories, no hype, no narratives, just 5 metrics. A company either qualifies or it doesn't. The 5 metrics are net profit margin, revenue growth, levered free cash flow margin, cash return on invested capital. PAG ratio. Miss one meaningfully, stock is out. No exceptions. I ran this filter across the global universe of publicly traded companies. Thousands of stocks. Only 2 passed cleanly. Nvidia, Broadcom. That's it. Let me show you why. Before we talk tickers, understand the standard. This is not about who might grow. This is about who is already executing at scale. The thresholds are simple. Strong profitability, sustained revenue expansion, real cash generation after leverage, high reinvestment efficiency, and valuation that makes sense relative to growth. If a company fails early, it does not advance. Fan favorites were eliminated. Popular names were eliminated because numbers don't care about popularity. Stock number 1, Broadcom. Let's run the metrics net profit margin, 36.2%. That means for every dollar in revenue, over 36 cents becomes net income. That's pricing power. Revenue growth forecast, 50% plus. This is not stagnation. This is expansion at scale. Levered free. Cash flow margin, 42% plus. That is elite cash conversion. Revenue is not theoretical. It turns into deployable capital. Cash return on invested capital, 19%. For every dollar reinvested, management generates nearly 19 cents in cash return. That is a compounding engine. PG ratio, 0.95. Growth relative to valuation is justified. You are not paying irrational multiples for fantasy expansion. Now, step back. High margins, strong growth, massive free cash flow, disciplined reinvestment, reasonable. Growth, adjusted valuation. Broadcom does not win because it is exciting. It wins because it executes infrastructure semiconductors, custom silicon enterprise software. These are not experimental spend categories. They are embedded. In a liquidity expanding environment, capital flows toward durable operators. Broadcom qualifies. No debate. Stock number 2, Nvidia. Now we raise the bar net profit margin, 53%. That is dominance revenue growth forecast, 60% plus, not incremental growth. Structural demand, expansion, levered free cash flow. Margin, 41% plus demand is not being consumed by operating costs. It is converting into cash at scale. Cash return on invested capital, 75% plus. That number is extraordinary. It means reinvested capital compounds at levels very few businesses in history have achieved. PG ratio, 0.73. Despite massive appreciation, growth still justifies valuation. Now think about that combination. Highest margins in the sector, explosive growth, elite cash generation, unmatched capital efficiency, valuation still rational relative to forwards growth. That profile does not appear often. You are not buying a chip, you are buying an ecosystem, hardware, software stack, developer moat, data center, dominance. And importantly, the business compounds even when the stock pauses. That distinction matters. Why only 2? Because strength in one area does not excuse weakness in another. Plenty of companies grow but don't generate cash. Plenty generate cash but don't grow. Plenty grow and generate cash but reinvest poorly. Plenty do all three but trade at valuations that erase future returns. When you require all 5 metrics to align simultaneously, the universe collapses. That is the point. Constraint creates clarity. The bigger picture, liquidity is expanding. Rates are stabilizing lower capital looks for scale, durability, and compounding engines. Money concentrates in businesses that already work. Broadcom qualifies. Nvidia qualifies everyone else. Today fails at least one critical test. That doesn't mean they are bad companies, it means they do not meet the standard. And investing without standards is speculation. If you want entertainment, chase headlines. If you want a repeatable framework, use guardrails, 5 metrics, no emotion, no loyalty, no narratives, just numbers. This is smart, wealth, code, build systems. Let businesses prove they deserve your capital and move accordingly.